Hey everybody, Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and of course one of the founding partners of the Dividend Kings marketplace service, also known by many of you as Mr. Valuation. In this particular video, I'm going to talk about finding value in this overheated market. And to use an old football cliche, the best offense is often the best defense. So what we're going to look at today is the defense industry. And what I've done is I've looked through the whole industry and I've come up with what I consider to be my top 7. 4 of them, as I'm going to illustrate here very clearly, I consider to be very attractively valued. These are what I would consider, by the way, the 7 bluest of all blue chips in the defense sector. I'm going to talk about 3 of them. I've called them honorable mentions. They're decent values. They're actually good companies and good investments, but their valuation might just be, a little higher than I'd like. I tend to be very particular, as many of you who followed my work for a while know. So I'm looking for a margin of safety whenever possible. And in the first 4 stocks I'm going to feature here, I think we have that. Now I'm also going to be sort of showcasing the new version of FastGraphs to many of you who haven't seen it before and aren't real familiar with it. This is in beta form right now. We haven't fully launched it yet. We do hope to launch it very soon in the next maybe 4 to 6 or 8 weeks or so. But I do have the historical graphs working. So I'm going to use the historical graphs here. And I'm going to go through these defense companies. And a couple things I want to point out as I do this, because one of the things I really like about the defense sector is that it tells such a really good story about valuation. And this has been true now going on for many, many decades. Valuation is real. I had a recent comment, an article that I posted where people were challenging. They're saying that a lot of people think valuation doesn't mean anything, that stocks are all about psychology. And in the short run, that can often be true for short periods of time. But in the long run, I always like to say earnings determine market price, and I qualify that by saying earnings and cash flows. So what I want you to notice as I go through each of these 7 examples here, and primarily the first 4, note how the relationship between earnings and stock price really work in the long run. In other words, where earnings go in the long run, stock price tends to follow. The black line on this graph is stock price. These are monthly closing stock prices. The orange line is operating earnings. I'm using operating earnings here for this presentation. The blue line is another valuation reference. That's a valuation reference. Now, the PE ratio for this particular company, we're using Peter Lynch's P equals growth rate formula for Huntington Ingalls here, is 15.55, because that's the calculated growth rate over this period of time. So this orange line is a PE of 15.55. The blue line is a PE of 14.59. And what you could say is that a 15 PE has been a very sound, very classic valuation reference for this company. Now, when that's true, and it is, by just looking at this graph, the evidence should be clear. There are times when the PE gets low, like here in September of 2011, it got down to 6. And one of my arguments is, inevitably, there'll be a reversion to the means. I guess you could put it in statistical terms. But to me, what it's saying is a stock will seek a company's intrinsic value. The price will seek its intrinsic value. There are times when it would get slightly overvalued, like we saw here. And then again, in very short order, it moved back to intrinsic value. And you see this same situation happening over and over again. Now, coming out of the last several years, I do want you to notice a couple of things. Earnings have been a little bit spotty for this company. The earnings growth was minus 31% in fiscal year 2019. It was followed with an 18% growth, and then for 12/21 there is an expectation of a minus 22% growth. Now that partially explains the stock moving from being overvalued at almost at a 19 PE ratio in January of 2020 to here we are in February of 2021 with a PE ratio of only about 11.79. That's the blended PE ratio we're looking at right now, which takes into consideration past, present, and current earnings. The point is the stock is undervalued. Now, I like a margin of safety. This light green shaded area, as many of you know, is forecast. So what we're saying is the analysts are forecasting growth to recover in 2022 to 21% growth, followed by 24% growth. So we have a couple of years coming out of this year, we have a negative year, and then a couple of years of really good expectations. So, if I go out here and look at this stock trading at a 15 PE, it could potentially be a $282 stock. If I simply calculate the performance out to there, I can make 19.5 or 19.4% total annualized rate of return. I'm using a $2,000 example. By the way, when I show you a feature of fast graphs, I can go to the external links here, and I'm going to change this to $1,000. Okay, just so the investment's easier to follow. And then I'm going to save the changes here. This is just for some of you who are, working in beta and so on. And I'm going to redo this calculation now. I'm going to do it here. Now I'm basing it on $1,000. And now I get a better, easier way to look at how the performance was. So what we have here over the next couple of years, 1,000 could turn to 1,580. That would be, a growth rate of 58%, an annualized rate of return without dividends of 17% per annum. Add in the dividends not reinvested without reinvesting, and that's what the WO would stand for. But this is just simply collecting the dividends. That would bring the total to 1663, or a 66.3% total rate of return gross, averaging 19.4% annualized. The stock has a margin of safety now. That's actually somewhat in excess of what the growth expectations are, but the opportunity here comes from the historical results. Now, talking about that, let's go ahead and look at historical results. And I'm using the old fast graph version here now for the performance because the new one's not quite ready for prime time yet. But anyway, if you put $10,000 in this stock on March 31st, 2011, which is essentially since it's been public in this form, that $10,000 would have grown to 42.9. You can compare that to the S&P here to the right. The total cumulative dividend income that you'd have received after buying 240, we'll call it 1 shares, 240.96 shares would be $4,525. You get over 45% of your money back, if you will, through dividends. Add that to the growth, where you get a total annualized rate of return of 15.9%. Add the dividends, you get 17.1%, and that's significantly better than the market did over this time frame. And I do want to remind you, this is a very strong market environment that we're looking at here from March of 2011 to current. So Huntington Ingalls has been a very good investment in that regard. The dividend growth rate, I want to mention, has been averaging over 80%, compound average growth rate about 59%. Now, you want to look at that realistically, okay? This is why, the old saying says statistics don't lie, but statisticians are darn liars. You had a massive increase in dividend, a 400% increase in dividends from fiscal 2012 to 13, and then it followed up by another 100% gain, and then 70. But more recently, we've been averaging about, we'll call it somewhere between 17 and 20% dividend increases. But that's extremely strong for a company whose dividend payout ratio, I might add, is still very opportunistically low at under 25%. Now, when you're looking at the historical graph, you can also see that graphically on the graph. You could point here and get the dividend payout ratio for each year, but this area below the white line is a dividend payout ratio. Now, this holds true for all the stocks I'm going to be covering here for you, but what I really want you to focus on, this is real-world evidence that earnings determine market price and that stocks trade in relationship to the operating performance that they generate. Very, very important to understand that. Now, another thing I'm going to feature about the new fast graphs, look how fast it is. People were teasing me and saying we ought to call it slow graph. Well, with the new version, by the way, it obviously loads much faster. But here's Northrop Grumman now, which was originally Northrop Aircraft, then they merged with Grumman, and now it's Northrop Grumman. But the point is, once again, you see that now there's a couple of other lessons about valuation here that I want to focus on. Number one is you do see this relationship between earnings and price, where the earnings of the company goes. That's the orange line. Now here we're using a PE of 15 and a normal PE of 14.16. These are just valuation references. How you should look at that is you should know that this is about a 15 multiple all across this graph. So now I can clearly see that during the '08 recession, the stock got very inexpensive. You can see the PE here was 7, and it stayed in these single-digit PE ratios for 3 or 4 years here. And then, all of a sudden we start getting some, resurgence of earnings growth, and then the stock, really grew. And then we see a period of overvaluation, and you get that classic reversion to the mean. It got undervalued, reverted back to the mean, overshot that, and now it's come back down again. So the defense stocks have been overvalued here, in the last year or so, primarily in 2019 and even the beginning of 2020. Now, as we get into the early 2021, Northrop Grumman is actually inexpensive. If I calculate the performance out to where I have good estimate data, I do want you to see, like we saw before, we've got an opportunity to annualize at 14% per annum. turn $10,000 into $1,567. Add in, the potential to get $90 in dividends. Again, this is on a $1,000 investment, and you end up with an annualized rate of return of 14%. Historically, this company has performed very, very well relative to the S&P 500. Now, I do want to be clear, this is a different time frame that we looked at with Huntington Ingalls a minute ago. This goes all the way back to 2001, December 29th, 2000 to be precise. A $10,000 investment over this long time frame would have turned into $79,000. That's a 10.8% annualized rate of return without the dividend. But I also want you to see that you would have received 120% of your original investment back through dividends alone. As I talked about in the written portion, for dividend growth investors, these kind of dividend growth stocks are very excellent because you can see dividends have grown here at an average of 11.6 and a compound average of 11.4%. The total rate of return is 11.6, and that's getting close to double what the S&P did, and the dividend income was more than double what the S&P did. These are the kinds of stocks that you can invest in, especially when their valuations are attractive. Now, I do want you to notice the valuation was reasonable back in the beginning time frame that I'm measuring here. Again, I want you to notice that periods of overvaluation are great times to buy the stock, and I want to just emphasize that a little bit. If you're able to, smart enough to buy this stock at 7 times earnings, even at today's discounted valuation, you'd have averaged over 22%. So you'd have done better even than the long-term average. Valuation is important. Had you been, aggressive and overpaid for it, well, then now in the last couple of years, you'd be looking at a negative rate of return. So this whole idea of valuation is what I'm all about, at least. I think it's so critically important. Now let's move on. Let's look at the next. These first 4 stocks, I believe, are the best of the breed that we're showing here. They have very excellent fundamentals right now. They've got good earnings growth. Again, what I want you to see is this very consistent, real world actual relationship between a PE of 15. And in this case, the market occasionally has, priced it a little higher. The blue line is a 16.4. Again, those are just valuation references because I want you to notice those numbers change when I change the time frame because they're based on calculating how the market has valued the stock over a period of time. The 15 PE ratio stayed the same because the growth rate suggests that that's warranted, but the normal PE changed. So I just want you to be aware of that, that this is a dynamic tool. But once again, we see this long extended period of overvaluation. But what a terrific time to buy the stock. Notice that the dividend increased every year. The earnings actually were a little spotty. You can see the flattening of earnings that occurred during this period of time, which obviously, diminished the value of the stock in the minds of certain people. But then as we came out of that, we got overvalued, just like we saw, a minute ago. And then, it reverted back to the mean, got overvalued, reverted back to the mean. And now we have the stock undervalued again, with a slight margin of safety here, with the ability to give us an annualized rate of return of about 13%, assuming it just reverts back to the mean and goes back only to a 15 PE ratio. That means the PE would have expanded from 13.6. The dividend yield is approaching 3%. When I look at this company compared to the S&P 500, we also continue to get this outperformance that I've been talking to. And you might not have noticed, but this stock was actually slightly overvalued, but it's been a tremendous grower, very consistent. A $10,000 investment made in December 29th, 2000. You'd have bought the stock at $33.95. You'd have bought 294 shares. Your dividend would have increased from $129 in 01 to over $2,800 in 2020. And for a total of almost 2.3 times your money out of the investment through dividends alone, but your 10,000 would have grown to 99,000, and you'd have averaged 12.1% capital appreciation or annualized return without dividends. Add in the dividends, and it boosts your annualized rate of return to 13%. This is a terrific long-term investment, and again, during a period where the market would have given you about half of that result. So once again, we have another classic example of a great defense company with a nice margin of safety. General Dynamics is one that I've featured many times before. Again, we see the same story. It's a very strong correlation between earnings growth and market price. We see periods of undervaluation. I always trust the blue line and the orange line more than I do the black line, which is the price line. By the way, I want you to notice the orange line and the blue line are virtually identical here. They're both at 15 times earnings. It just happens to be the case So you can see this very consistent 15 multiple. You see overvaluation. The company came back into fair value. You see a little hiccup in earnings, COVID, I guess, if you will. The market value of the stock dropped rather precipitously. Now it's moved back into fair value territory. This one doesn't have a great margin of safety because it's trading basically at a 14.8, or we'll call it right at that 15 multiple. But even then, we have an 11% potential rate of return, going forward. So if I look at General Dynamics' historical performance over this time frame, once again, we see outperformance of the market, not quite as strong as we just did. This is December 29th, 2000 I'm looking at here. Time frame, you would have gotten 100% of your money back in dividends. Look at your growth yield. People call this yield on cost, which is what we have it labeled here. I like to think of this as growth yield because what's happening is your yield on the original money you invested is increasing every year. This is what I referred to as a raise in pay. If you build a portfolio of dividend growth stocks like that, let's say in your retirement years, you can look forward to seeing your income increase every year, just like perhaps it did when you were working for a living. Now you've got your money working for you instead. So that's something to also consider. I'm going to move along a little quicker here. We get into L3Harris Technologies. Once again, it's just, it's the same old song. You see this relationship between price and earnings. You see another defense company whose price was very undervalued, coming out of the Great Recession. It got overvalued, reverted back to the mean. And now we've got some very strong, growth forecast here. So we do have a potential to see about a 13% rate of return going forward. If I look at this company from the standpoint of its performance historically, a $10,000 investment December 29th of 2000 would have grown to $131,000. It would have thrown off $16,000 in dividends. And once again, you see that dividend income increasing year after year. Average dividend growth rate over 21%. $10,000 including dividends would be worth $146,000 today. That's significantly better, more than double the rate of return of the market. And same with the dividend income, 3.5 times or so what you'd have received if you'd have invested in, let's say, an index fund. Buying a selective high-quality dividend growth stock when it's attractively valued, and I want you to notice the valuation here was actually even a little high, but we had 16% growth. And the PE ratio I'm using here on this orange line is the P equals growth rate. That's a 16 multiple that I've got here, and the blue line's a 17 multiple in this example. So moving on here quickly, because I think you're getting the idea now, we go to Curtiss-Wright. Curtiss-Wright is actually moderately overvalued, but once again, we see a very similar story, a very high correlation between price and earnings. We see periods where even here, if you look at this closely, here's a period where you could have gone through, a year or so with virtually no rate of return, and yet the business grew by 20% each year during that time. You were simply overpaying for a great stock, and you therefore didn't make any money. But if you buy the stock when it's attractively valued, even if you only measure it to fair value, and I'll try to hit that, I'll go ahead and measure it here, you end up with a 17% annualized rate of return, which is actually pretty terrific. So, let's go ahead and look at its historical performance over this time frame. $10,000 would have grown to $97,000. That's a 12% annualized rate of return. Add in your $6,000 in dividends, which was more than the market, but not quite as much as we saw with some of the other examples. You still have a 12% rate of return, more than almost doubling the annualized rate of return that the market did, with a dividend that's growing between 9 and 9.5%, per annum. So again, another quality company. This one's a little more fully valued than some of the others, but I think it's close enough that if nothing else, I would have loved to have bought it down here. I didn't, because I ended up buying General Dynamics and some others. But the point is, that would have been an attractive purchase here. Curtiss-Wright is a excellent company. Moving on, we go to Raytheon Technologies. Now, this is an interesting story because there's a couple of things about this stock that I want to make a point of. This was a merger between United Technologies, which I owned for many, many years, and Raytheon Corporation, a year or so ago. We end up with this big drop in earnings and this kind of COVID-related, but I think this was also had to do with the merger. Anyway, make a long story short, from here back, you're really looking at United Technologies. But, you still see a very consistent relationship between earnings and market price. I want to make that clear. When I look at, historical performance, it's outperformed the market on a dividend basis for sure. It's, I'll call this a dead heat with the market, but your total return ended up being slightly better than the market. So if you were looking for dividend income, this was still a very excellent choice. The key is that, this merger is muddied the water a little bit. Otherwise, this has been good. Now, the stock is pretty fully valued right now. I wouldn't recommend buying it here. I'd like to, buy it down here in the, $50, $55 range. But even then, because of the growth expectations, you can make 11 or 12% going forward. So it still is a quality defense company, but it's not as inexpensive as some of the other ones I showed you. So anyway, there you have it. You have some of the, the finest defense stocks on the planet. Some of these stocks are very, very attractively valued right now. 3 of them I called honorable mentions. And no matter what kind of market we're in, it's a market of stocks, not a stock market. The overall stock market may in truth be overvalued today, but as I stated in the written portion, if you're willing to look at certain sectors and certain industries, the defense sector right now is full of good value with the best of breed companies in that sector. The 7 here that I've gone over with you. I hope you enjoyed this article and this video. This is Chuck Carnival, aka Mr. Valuation, telling you to invest wisely, choose wisely. If you like what you saw here, don't forget to ring the bell. Give me a like and subscribe to the channel if you don't already, and share this video if you think others can benefit it. I'd appreciate it, and I think they would too. Anyway, thanks for watching.